Hello investors, welcome to the channel. For today's video, we're going to be going through the difference between the covered call option strategy and the PMCC option strategy, better known as the poor man's covered call. Now, if you're new to options or you're trying to use options in order to make some extra money, then you stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's option video, we're going to be focusing on the PMCC and covered call option strategies. I'm going to be showing you the difference, and then you get to decide, yes, you get to decide which one is better for your portfolio based on what we're going to go through today. Now, to start off, both of these option strategies are extremely good option strategies, and I refer to them as a win-win option strategy, and that's going to be highlighted as we go ahead in the video. Now, the only way for you to learn options trading and be good at it is for you to practice, practice, practice. So let's go ahead and do what we do good on this channel, which is to get down and dirty with options. So we're going to go ahead now and open up the Micron technology option chain, and to do that, we're going to go to the bottom to hit trade MU option. What that's going to do is that's going to open up the option chain in order for us to get this going. Now, before we get into the actual examples right now, I need you guys to do yourself a favor. You know what? Do yourself two favors. Favor number one, always make sure you do your own due diligence before investing. Favor number two, always make sure to have an exit strategy before entering any option contract. Once you guys have done yourself those two favors, then you're clear to proceed. Now we're going to start off with the covered call option strategy, and then we're going to finish off with the PMCC option strategy. And we're going to do a summary of which one is going to be better for your portfolio. So in order for you to do a covered call option strategy, you must first go to sell and call, and then you're going to go ahead and choose your expiration date. Now the expiration date I'm going to use for this video is going to be February 14th. Now, the reasoning behind that is because the next expiration date is going to be February 7th, which gives us 1 day to expiration. I'm not much of a gambler, so that does not work for me. The February 21st gives you 15 days to expiration. Now, I'm not going to choose that one because that gives the option buyer too much time to work in their favor. So February 14th is perfect for this particular stock. Now that we have sell and we have call and we have chosen our expiration date, now we're going to go ahead and we're going to choose our strike price. Now the strike price we will be using is going to be the $100 strike price. Now I know when I do these videos, these strike prices look completely random, but I assure you they're not. And you will see this as we go along in the video. Now, one of the reasons why I decided to choose the $100 strike price is because of my chance of profitability. When doing the covered call option strategy, I like a chance of profitability anywhere 80% or above. I feel comfortable with that. Now, with the strike price of $100 and the chance of profitability of 83%, I'm going to be paid a certain amount. The amount I'm going to be paid is going to be 0.75. Let's go ahead and click into that. Now, this 0.75 cents in the real life is going to work out to be $75. Each option contract is multiplied by 100 shares. Now, as you can see here to the top, the covered call option strategy. Now, I know you're asking yourself this, why would I receive a premium? Well, that's one of the benefits of doing the covered call option strategy. It's one of those option strategies that as soon as you decide to do it, you receive a premium right away. This premium is what you're going to use to grow your portfolio over time. Now, this is how this is going to work out. With the covered call option strategy, you're deciding to get into a contract. The contract has a couple stipulations. So what you're actually saying is that some expiration date of February 14th, if Micron is trading at any price at $100 and above, then you're going to have to sell your 100 shares. Now, I know you're asking yourself, why is it 100 shares? It's 100 shares because each option contract is multiplied by 100. So you could only do this in multiples of 100. Now, so you're going to have to sell your 100 shares. But here's one of the good parts about this strategy is that you get to maintain your $75. That is yours to keep no matter how this trade goes. Now, in the event that the trade works against you and the same expiration date of February 14th, Micron is now trading at any price below the $100 mark right here. Then you get to keep your 100 shares, you get to keep your $75, and you get to keep doing this strategy over and over again while collecting consistent premium in order to grow your account. Now, there's another part of this that makes the covered call option strategy a genius option strategy. Now, here it is. Let's say you actually bought this stock today at around $95 per share. You would have to spend $9,500 in order to acquire 100 shares. Remember, you cannot do options if you don't have 100 shares or more. So if you were to get assigned, meaning February 14th, Micron is trading at any price above $100. If you were to get assigned, means you're going to have to sell your 100 shares. Now remember, you picked up your 100 shares at $95 per share, and you actually spent $9,500 to pick up 100 shares. Now you're going to be assigned, and now you're forced to sell those same 100 shares at $100 a share this time. So now you're going to be receiving $10,000 instead of your $9,500. The difference is going to be $500, and once again, you get to pocket that $500 in addition to your $75 you receive right here. Hence, a win-win option strategy. Now, I would like you to remember a few things before we move into the PMCC option strategy. We're going to remember the $100 strike price, and we're also going to remember the share price right here. Now, let's go ahead and jump into the PMCC or poor man's covered call. Now, with the PMCC option strategy, this option strategy involves two smaller option strategies. So the first strategy is going to be to buy an actual call. So we're going to go to buy, we're going to go to call, and now we're going to choose our expiration date. And for this, we're going to go way out. We're going to be going with the January 16th, 2026 strike prices. Now, for the PMCC to work, you need to buy a long call or a LEAPS option. LEAPS is an acronym that stands for Long-Term Equity Anticipation Securities. Now, with the LEAPS option now, in order for you to maximize the efficiency of this option strategy, it's highly advisable that you're going to go ahead and choose your strike price below the current share price. So we will be going with let's see, we're going to do the $65 strike price right here. Now, with the $65 strike price, our break even is going to be $100. We're going to get back to that in just a second. And now, because we're going to be buying a call, we're going to have to pay. The amount we're going to have to pay is going to be $36.30 per share, which is going to work out to be $3,630. Now, remember, I just mentioned you need to remember the $100 strike price. Now, with this LEAPS option or long call option, Robinhood actually makes your life so much easier. Robinhood give you a break even right here. So what Robinhood is saying, in order for you to be good and make consistent income and not lose on this trade, you're only allowed to do covered calls above the $100 break even. That's why we use the $100 in order to do the covered call option strategy. Now, this is a LEAPS option. Once you own a LEAPS option in your portfolio, that now allows you to control 100 shares of the stock. The covered call option strategy, you need to buy 100 shares of the stock. So in that strategy, you own 100 shares. The PMCC, you control 100 shares. Now, the other difference is with the covered call option strategy, you had to be out of pocket of $9,500 in order to buy your 100 shares. Now, with the PMCC option strategy, you're going to be out of pocket for only $3,600. So if you're trading with a small account, then the PMCC option strategy is going to work better for you. That's one reason why it's going to work better for you. Now, with the previous example, we're going to go back to the covered call option strategy, and now we're going to assume that we have a LEAPS option in our portfolio. So we're going to go back to the exact same strike date, which was February 14th, and we're going to go and do the exact same thing. So when we chose the previous strike price of $100, we receive $75. Now, this $75, if you were to divide it by the amount of money you paid to buy 100 shares, you're going to get a return of less than 1%. Now, according to my own personal risk tolerance, I think 1% is too low for me if I'm doing the covered call option strategy. So 1% is just not going to work for me. Now, let's assume that we're using the leaps option strategy in order to sell covered calls. So your PMCC is when you sell covered calls against the leaps option that you have in your portfolio. So we're going to use the exact same $75 example, but now you're going to be dividing $75 divided by your $3,600 you paid to acquire your leaps option. Now, your percentage return is going to be way higher. If you do the math, it should be around 2%. Now, in my opinion, 2% is a lot better on $3,600 than 1% on $9,500. But remember, the choice is always yours. No one could tell you what to do with your portfolio. Now, with the leaps option in my portfolio, the whole point of having a leaps option in your portfolio is because you want to keep that in your portfolio as long as possible because you think the stock is going to go up. So that's why you went out over a year. So you have time on your side. Now, my personal preference when doing covered calls on your leaps option, the PMCC option strategy, I usually tend to get a higher chance of profitability. And the reason for that is because I want to keep my leaps option in my portfolio. So with this example, I would not be going with the $100. I would be going to 102 for doing my PMCC. Now, for that, I get a higher chance of profitability, meaning there's a higher chance of the trade going in my favor, but I'm going to be receiving a lot less money. But the lot less money I do not care about because I'm still receiving money. Remember, the whole purpose of buying a leaps option is to keep it in your portfolio as long as possible. The extra income that you make doing covered calls is an additional bonus for you actually owning the leaps option. So now that we went through the leaps option and we went through the covered call option strategy, you get to decide. If you were to do the covered call option strategy, the capital expense to start off the strategy is going to be extremely higher than the PMCC. When you're doing your covered calls, it's highly advisable that you do your covered calls at a less chance of profitability if you actually own the stock outright. Now, if you're using your leaps option in order to do your covered calls, then I would advise you go for a higher chance of profitability because the main goal, once again, is to keep the leaps option in your portfolio. Now, one thing to note about the leaps option as opposed to the covered call, if you own the shares outright, any movement in the share price is going to reflect exactly as it is. However, with the leaps option in your portfolio, every dollar increase in the strike price is going to be multiplied by whatever your delta is. We're not going to go into delta right now because I don't want to make this video too confusing. So if you're trading with a small account, the PMCC is your best bet because your chance of getting into it, the capital is a lot lower and you're still able to make consistent returns. The covered call option strategy is going to work better if you already own 100 shares of a stock and all you're looking for is just to make additional income. Now, both of these option strategies are win-win option strategies. My best option strategy that I've been doing time over time, which has always worked out for me, is the PMCC option strategy. So that one right there is my favorite that I'm going to continue doing in order to continue growing my portfolio. Now, I hope you guys see the difference between these two and I hope you guys have made your decision. Let me know in the comments below. Which one of these option strategy would you prefer to add in your portfolio? The covered call option strategy or the PMCC option strategy? Thanks for watching. Like the video, subscribe to the channel, but most importantly, share the video with someone you think that can benefit from this content. And until the next video, keep pushing your investments.